We're back on Market on Close. Let's close out today's show and welcome in Tammy Trenta, founder and CEO of Family Financial. Tammy, thanks so much for joining us. Great to have you here with us.
Yeah, thanks, Carolyn. Thanks for having me.
So, Tammy, you get the last word about the market this week. What's your take? We saw kind of a mixed day today, but strong week, really impressive gains. What do you make of all of it?
Yeah, well, I know we started off the year with a lot of headwinds and uncertainty, and now that we're more than halfway through the year, that soft landing seems to be happening, and I feel like we're entering a period now where we're seeing sustained levels of growth, stabilized inflation, and consumers are still spending money. There's also been an increase in Social Security because the CPI, it's tied to the CPI. And, clients have benefited from lower tax brackets because the rates went up and their taxes went down. And, they still have a little bit of stimulus. So I feel like we're in a new normal where we should expect that interest rates remain where they are for the foreseeable future. And that could potentially put pressure on publicly traded companies that have a lot of debt because that debt expense has now gone up. And so what I'm looking for really is companies that have healthy profit margins, a low amount of leverage, that are undervalued and have potential for growth.
I want to talk about those picks in just a second. But if rates are staying higher for longer, ultimately, is this a market that moves higher or lower from where we are right now?
I see the market moving higher, but maybe not the massive growth that we've become accustomed to, at least for the foreseeable future. I think we've just got to adapt to the interest rates, and who knows whether we'll even get to the 2% desired inflation rate that the Fed is hoping for. But in any case, stocks are still strong, and there's so many strong signals in the market. It's hard to ignore that. And it doesn't make sense to be fearful of something that may or may not happen.
Okay. You have 3 individual stock picks, but before we get to those, I keep leading up to it. I'm looking at your sector trends here, and it says finding value in tech, AI, energy, and healthcare. Are you still finding value in tech and AI, and where is it? Because so many of these companies have run so far this year.
Yeah, definitely. I see you have to look at opportunities in that space, and you can see who's captured a lot of that. And Microsoft certainly has. They're still attractive, but when you compare it to Google, I still think that Google has a lot of upside potential. And the way that they're integrating AI with their search engine, I think will attract more users. They have a pretty healthy PE and profit margin of 21%. And so at a stock price of $135, I still think it's fairly valued.
Okay. All right. Yeah. 135.66 today, up more than 50% year to date, but value there. So that was your first pick. Next up, BioNTech, BNTX. Tell us why you like that one.
Yeah, so, BioNTech is a German-based company, and they partner with a lot of the big pharmaceutical companies. They're a large company, and they, really, during COVID, made their mark with adapting the immunizations and being able to help with the COVID vaccination. Their primary focus is in oncology. And, they really have a unique positioning in the market that's hard to compete with. And so, when you're looking in the healthcare sector, I think, and you're looking past pharma and biotech, I think this is also a very attractively priced stock right now where it is. They have a forward PE of 19 and a profit margin of 47%. It's priced at 122.
Okay, and down about 19% year to date, so value there. Yeah. And then your last pick is Coterra Energy, CTRA, up about 16% year to date. Tell us why you like this one.
Yep, so that's a little bit of a different play. Cetera's kind of a small mid-cap energy company, primarily focused in Texas, where they own land, and they are a provider of liquid petroleum and natural gas. So why I like them is that they have the real estate that they own is the lowest cost oil and natural gas basins. And so they're able to amplify returns and boost product while also having geographic diversification. They also avoid the NGL natural gas liquefaction processing fees because they focus on dry natural gas. So that normally would drive up production costs. And the firm is one of the few oil and gas producers that consistently generate excess returns on invested capital in mid-cycle commodity prices. So from a timing perspective, we like that stock as well. And it's a good fit for our energy sector.
All right, we'll leave it there. Appreciate those picks. Tammy Trenta, Family Financial, always good to see you. Thanks for wrapping up the week with us.